Hello, everyone. Today, we're going to be tackling a big topic for UK homeowners, the relationship between equity release and inheritance tax. It's a really important conversation if you're thinking about your financial future and, of course, the legacy you want to leave for your family.
Now, this entire discussion has been arranged for us by the experts over at ProTax Accountant. They live and breathe this stuff, helping people make sense of these very complex issues. So let's get right into it.
We're kicking things off with a pretty heavy question, aren't we? But it really gets to the heart of the matter. How can you fund a comfortable retirement for yourself without chipping away at what you'll eventually leave behind? It's a tough balancing act, and today we're going to explore one possible solution.
So here's our game plan. First, we'll get to grips with the key terms. Then, we'll look at a potential strategy for inheritance tax. After that, some really crucial reality checks. We'll touch on future tax changes you need to know about. And finally, we'll talk about your next steps. Okay, first things first. Before we can talk strategy, we absolutely have to be on the same page about the two main financial tools we're dealing with today.
So let's start with inheritance tax, or IHT as you'll hear it called. Put simply, it's a tax on your estate. That's all your stuff, your property, your money, your possessions, when you pass away. It's paid by the estate before your family gets anything.
Okay, let's talk numbers for the 2025-26 tax year, because this is where it gets real. The standard rate is a whopping 40%. But, and this is important, everyone gets a tax-free allowance of $325,000. Plus, you can get another $175,000 if you pass your main home to your kids or grandkids. So you add all that up, and a couple could potentially pass on £1 million, completely free of inheritance tax.
And here's the second piece of our puzzle. Equity release. This is for homeowners, usually over 55, and it's a way to get at the cash that's locked up in the value of your house. And the two big takeaways? The cash is tax-free, and you don't have to pack your bags and move. Now, equity release usually comes in two main flavors. With a lifetime mortgage, you're basically taking out a loan against your home, but you still own 100% of it. With a home reversion plan, you're actually selling a chunk of your property. The massive difference here is ownership, and believe me, that has huge implications for your estate.
Right, now we've got the building blocks. So let's see how they can fit together to create a really interesting strategy. This is where we connect the dots between releasing that equity and potentially shrinking your inheritance tax bill. The thinking behind this is actually pretty straightforward. Step 1, you release tax-free cash from your home. Step 2, you gift that money to your loved ones. Now, here's the catch, the really important part. If you live for 7 years after making that gift, it falls completely outside of your estate for tax purposes. And what's the end result? You've lowered the taxable value of your estate, and you got to help your family while you were still around to see it. That all sounds good on paper, right? But what does it actually look like when you use real numbers? Let's make this crystal clear with a quick case study. So let's meet Robert from Birmingham. His home is worth £800,000. Now, if he does nothing, that property value is likely going to create a pretty hefty inheritance tax bill for his kids down the line. So, Robert decides to take out a lifetime mortgage. When he eventually passes away, the loan plus all the interest that's built up comes to £340,000. And here's the absolute key. That loan is a debt against his estate. So for tax purposes, you subtract that debt from the home's value. Just like that, the taxable value drops from £800,000 all the way down to £460,000. And this chart just shows the outcome perfectly. Robert's total tax-free allowance is £500,000. And because the net value of his estate is now only £460,000, it slots in completely underneath that threshold. So in this scenario, zero inheritance tax is due on his home. A massive saving. But, and I really can't stress this enough, this strategy is not a magic wand. It's a major financial decision with very real consequences. So let's move on to some crucial reality checks. First of all, remember that equity release loan has compounding interest. That means the amount you owe can grow and sometimes grow really fast, which will definitely reduce the final inheritance. Second, that 7-year rule is a hard and fast rule. If you don't make it the full 7 years, the gift could still be taxed. And finally, suddenly having a big lump of cash could mess with your eligibility for certain state benefits. You've got to be careful. And just to add another layer of complexity to all of this, the tax rules are not set in stone. In fact, there are changes coming down the track that make planning ahead more important than ever.
Just look at this timeline. From April 2026, reliefs for business hours are changing. But the really big one? From April 2027, many pensions, which used to be protected, are going to be subject to inheritance tax. This is a game changer. It means many estates that are safely under the tax threshold today could easily be pushed over it in the near future, making these kinds of strategies even more vital to consider.
So, with all of this on the table, the strategies, the risks, the big changes on the horizon, what should you actually do next? How do you figure out the right way forward?
Well, the single most important thing to take away from all this is that there's no one-size-fits-all answer. Every single person's financial situation is unique. What worked for Robert in our example might be completely the wrong move for you. Which brings us right back to that big question. What is the right path for your family and your legacy? Answering that takes some serious thought, and frankly, because the stakes are so high, it's a conversation you really need to have with an expert who can give you truly personalized advice. And for exactly that kind of tailored, professional advice, you can get in touch with the team at Pro Tax Accountant. You can reach them on WhatsApp or by phone at 07985689912, or you can drop them an email at info@protaxaccountant.co.uk. I hope this discussion has been helpful. Thanks for tuning in.